Hello and welcome. Hello and welcome. Straight away, let's go to our first market guest. Jitendra Arora of ICICI Prudential is now with us. Jitendra, thanks so much for taking out time for us. One thing that's pretty clear is that earlier, I'm sure you would have heard this phrase that if FIR does not buy, who will come out and buy? And we have seen this for the last few quarters that, retail investors, mutual fund, HNI category, PMS itself has become quite self-sufficient for the market as well. So what do you make of this change in the trend that we've seen in the last, 12 to 24 months?
No, so honestly, it's a very welcome trend for the Indian capital markets and Indian equity markets as well, that more and more savings can get diverted towards equity. However, as we know that FIIs still form a good chunk of investors for Indian markets over a period of time. So if we have the domestic flows going while the FII flows are coming, then it's even better. It's like more the merrier. But if it's only one of the guys investing and the other set of investors are exiting market, then obviously then markets will see some volatility or some kind of correction either in through price or time that we have witnessed in last 12 months.
All right. Do you expect these flows to be sticky in nature? Do you expect the SIP flows, the fund size of mutual funds to only increase from here on?
So not just SIP flows to mutual funds, we have seen flows to equity market from all quarters, be it the insurance investors, be it the mutual fund investors, be it the EPFO. So overall, we are seeing more savings getting channelized towards equity markets over last 2 to 3 years. And we believe that there is a base level of flow which will remain sticky into equity markets. Having said that, on top of that, there is always a lump sum flow which can move into either direction depending on where the markets are at any given point in time. But overall, we see close to around 90 to 100,000 crores of sticky money into Indian markets from domestic savers annually.
In terms of Indian markets, what do you make of the so-called high valuations? You think again that's a structural shift that people are talking about? Is that something which people are comfortable with now, that we're paying slightly higher but we're getting more stability in India than what it was earlier?
I will tend to agree with that in the sense that there are three components to the price to earnings or market valuations when we are looking at. One is obviously the composition of the basket. Now, I would want to highlight that Indian basket for both the for Nifty index has changed materially over last 15 years from a lot of medium to low PE stocks to a lot of high PE stocks with more and more consumer stocks coming in. So inherently, there's been a shift in the PE of the index itself, everything else remaining the same. That is first. Second, compared to rest of the global markets, when you look at India, India still perhaps presents an opportunity where you can see that the GDP growth itself can be in double digits on a nominal basis over next decade. And we have realized that the long-term GDP growth in turn translates into the earnings growth. So India is still a market which can perhaps deliver double-digit nominal earnings growth over a longer period of time. And it's a large market which can absorb flows. So to that extent, it remains a very, very attractive destination for the investors who are looking at markets from a 5-10 years perspective. And that's what perhaps justifies our premium to a lot of other emerging markets. Having said that, there will always be points in time where people will see that maybe you are likely to see a correction either in terms of time correction or in terms of price correction. And that is the points perhaps where markets will give an opportunity for new investors to come in and old investors to perhaps book some profits out.
Right. So where are you putting your money? You as a fund manager, you as a person who manages funds of others have a lot of restrictions. So how are you managing in this market? What is your approach towards investing? Is PE now or valuation now one of the key criteria? Because some of the sectors and stocks are really valued pretty heavily versus their averages.
Yes. So obviously, as a fund manager, you'll have to try and see that what are the sectors that are likely to do well in the near term as well as over a longer period of time, and try and strike a balance between the two when you're looking at investing uh, into the markets. So we, as a house, and personally, I find a lot of sectors attractive at this point in time. So financials being one, especially the large banks. The telecom is a sector where we are overweight. In addition to that, we still have some exposure to high PE stocks where we believe that the growth can continue to be very robust over next few years, and these 6 month to a 1 year blip perhaps should be used to increase our exposure to some of these stocks.
I'm tired of you. So when we look at the sectors, how would you look at domestic versus the new age economy? People are factoring in very high growth, and of course, growth is something which equity was always look at. But how would you look at the traditional businesses which really have no interest? Do you think that's the space where investments can be done? Manufacturing, cap goods, they have also seen a rally after a very long period of no interest from investors.
Right. No, so if at all people talk a lot about the PEs for the new age businesses or some of the consumer businesses, but today if I look at the PE multiples for a lot of capital good businesses, they're also competing with them at a level. There are capital goods companies which are trading at 50 to 60 times multiples. So obviously they are also trying to factor in a lot of growth in the coming time period. And that is in line with many consumer businesses where at least we have seen that those have compounded at that rate in terms of earnings as well as top line. So to that extent, we are trying to strike a balance wherever we can find opportunities in this market uh, without trying to get swayed by the ongoing narrative per se.
Right. And recently, of course, we've also seen that, there was a lot of technical reasons why some of these new age stocks saw a lot of supply coming in. You think it's an opportunity to buy, or only when the free float is actually very high, the real valuations of stock come out? What does history tell you?
So honestly, I don't think history in Indian markets is a very will be very relevant here because some of these businesses we are seeing for the first time. Apart from the technical factor that we have a supply, we should also not forget that we have seen a rise in the interest rates, which mean the cost of equity itself has gone up. So when you were valuing these new age businesses, let's say 1 year earlier, you were looking at a certain cost of equity, and suddenly you realize that now that cost of equity has to be shifted up, and that should lead to some kind of correction in the valuations of these new age businesses. Plus, the profitability still remains a challenge for quite a few of them. And even though they are guiding for profits, market would want to see that once you turn profitable, what kind of growth can you show? For them, we understand that there is always a trade-off between profitability and growth. So obviously, this will be a period where you will see a lot of volatility in these names, and obviously there will be levels at which you would want to buy these names from a long-term perspective, and you too do get those opportunities from time to time. Overall, we are turning more constructive on some of these new age businesses per se.
Right. In terms of real estate, we've been speaking to a lot of companies, right from DLF to Prestige to Shobha, and all of them are talking about positive trends, about positive demand. What's your view on real estate? Generally you would say that in a such fast rising rate environment, avoid rate sensitives like real estate. But do you think this time it's different?
For the near term, I believe the real estate demand continues to look robust because obviously we have seen a lot of wage increases across a lot of sectors in last 2 years, driven by technology sector at the forefront, and we've also seen good job generation in some of these sectors, which is in turn driving demand for a lot of real estate across the cities. So near term is likely to be robust. Obviously, the impact of interest rates is yet to be seen in terms of demand, and I think we may see that 2 to 4 quarters down the line, and that's when you perhaps need to have a deeper look at this sector about where it is headed. But I think it looks good to me for at least another 2 to 4 quarters.
Right. When I just look at the IT pack, till October 2021, there was a lot of interest in these names. People were saying that this is a structural move, but we've seen a decent amount of derating, marginal EPS cuts as well. What do you make of this underperformance from large IT names?
So if you see on an average where this large IT pack was trading before COVID and where it is trading now, you will realize that perhaps this large IT pack is still trading at a premium to where it was trading on a pre-COVID basis. Obviously, that premium has been driven by two things. One was the kind of growth these names have shown, and also a belief that structurally perhaps we can see 100 to 200 basis point higher growth from the industry per se over the next 4 to 5 years, given the changes that are happening in the global markets and where these companies stand to gain. Uh, Now, along with that, we are also having a situation where US is expected to slow down dramatically. Whether it is soft landing or whether it is recession is yet to be seen. So that is, I think, what is leading to this uncertainty where markets are trying to find a level where these companies should be trading. So I do expect the sector to continue to be volatile, but maybe in another 2 quarters, we should see perhaps it wherever it is, from there on, we should be very constructive on this sector, because by then we would have seen whatever demand patterns to emerge would have emerged by that time.
Right. So just in terms of how things are moving in terms of, IT pack, which you just pointed out, that it could be interesting. Now, when you look at the IT names, it's the sector itself has become vast. Something like a Mindtree has really become big. Coforge has really become big in terms of size. So how would you look at it? Because earlier it used to be about Infosys, Wipro, TCS, maybe the top three, four. But now, are you expanding your horizon?
Yes, definitely one has to expand your horizon, because clearly there are times when the size makes you eligible to sit in certain deals where you were not able to sit earlier. So suddenly your addressable market in some ways goes up. So some of these mid cap companies are now coming into that bracket of top line where they can participate in more and more deals, and as a result try and win more deals by competing with some of these large cap names. So to that extent, we can see that growth may be higher for some of these names over a period of time. And as an investor, one has to be open to looking at them.
All right, sir. Thank you so much, sir, for taking our time for us. Always good to get perspective.